Hello, my name is David Klaas. This is the equity research report for Tesla Motor Company, Inc. Global Finance, FIR 7155, Fall 2014. Let's begin with overview and highlights. Tesla Motor Company, ticker TSLA, is an outstanding company, and after much thought and consideration, my recommendation is to sell this stock. Price target for 1 year as of 12/31/14, which is in a few weeks at this point, I settled on 206.39 with the current price when this was originally created as of 10/22 of 231.10. Now, some of the main highlights. First, Tesla Motors Inc. current stock price greatly exceeds the fair value of the company. Second, Tesla significantly increased revenues and debt in 2013 and will continue on this trend in 2014, making a sell the right play. Tesla stock has significantly outperformed the market, however, with a 387% gain in 2013 and a 102% return in 2012. I don't believe this trend can continue. Tesla does, however, have aggressive expansion plans. I don't know how they're going to be able to finance this unless the stock continues to rise, which I don't believe it will. Now for a brief summary of analysis. Tesla stockholders have enjoyed incredible returns since the IPO in 2010. Tesla stock has continued to climb despite zero earnings and high leverage. At current market prices, it will take Tesla years of profitable growth to reach the current valuation of the stock. The price-sales ratio was used in this case to value the stock due to Tesla's negative earnings. My recommendation is for stockholders to sell shares and take profits now. The market cap on 10/24, as I mentioned, was $29.32 billion, and my forecasted 2014 sales are $2.8 billion. Now this represents a price-sales ratio of 10.54. I project Tesla stock to close 2014 at 206.39 based on revenue estimates in 2014 and the rate of historical growth of Tesla stock. So, in summary, Tesla's returns have been overwhelming thus far. The price-sales ratio was used to value the stock. I think you should sell this stock and take profits now. And finally, the 3-month, 1-year, and 5-year trends show explosive growth. While Tesla's stock price has been flat for the past 3 months, announcements of Tesla's new Model X gave the stock upward momentum, but there has been recent pullback in the overall market, which has kept the stock from further gains in the past 3 months. 1 year out, Tesla stockholders have seen significant gains of over 100%, and Tesla has recently become the leading luxury sedan in the U.S. car market. As far as growth since the IPO for Tesla in 2010, Tesla stock is up over 13-fold since that IPO. If Tesla can be successful in turning a profit through its Gigafactory, China expansion plans, supercharger network, and the new Model X, the company could continue to provide market-beating returns, but I think it's unlikely at this point based on their financial position. Recent news for Tesla. First, the Gigafactory. This has been in the headlines lately, and this is going to double worldwide capacity of lithium-ion batteries. It's a huge moat for Tesla. Second, China. Tesla is aggressively building partnerships and a distribution network in China. This is going to position the company to take advantage of a massive growth market. Next, superchargers. Tesla has announced plans to continue to build out the network of supercharger stations across the U.S. and internationally, which should make more customers a realistic possibility. Again, the Model X, in the second quarter of 2015, the Model X will be available for consumers. And finally, Tesla plans to introduce their third-generation electric vehicle by 2016, and this is going to be in the $30,000 to $35,000 price range, which is going to make electric vehicles much more affordable for the average U.S. consumer. This is a quick graph on Tesla unit sales. Tesla unit sales by product from 2012 and then as a forecast to 2028. As you can see, the current vehicles on this graph are the Roadster, Model S, Model X, and then into the future for the Generation 3 and powertrain model. So as you can see, Tesla has exponential growth plans forecasted. Now for the SWOT analysis. Strengths. Founder Elon Musk, I think, is the biggest strength of Tesla, and Musk is well regarded as a pioneer and one of today's elite business leaders. Musk's reputation and successful track record have created consumer confidence and strengthened Tesla's brand. Next, Tesla has a niche product, which are electric cars, and there's no strategic plans to move into other alternative fuel autos like fuel cells, hybrids, or ethanol vehicles. So Tesla is going to stick to their niche, which is a good move. Next, Tesla's in the late stages of product design for a 200-mile battery. So Tesla's R&D team is working on improving their product consistently. Next, Tesla factories are built for growth and only utilize 20% capacity today. So there was some nice foresight from Tesla's management team for future growth. And finally, a strength for Tesla is that it has the largest supercharger infrastructure in the electric car market. On to weaknesses. One weakness is Tesla is viewed by many analysts as growing too quickly, which I agree with. Tesla has gone from producing a few hundred cars to a few thousand in fewer than 2 years. There's a public perception of safety issues and poor performance of electric vehicles, and that needs to be overcome. Next, no earnings and huge debt make Tesla a risky proposition in the near term, even with increasing revenues as seen from 2012 onward. Next weakness would be, although the supercharger network exists, it's still very weak. And finally, Tesla's stock is heavily traded and overpriced, even according to Musk. The volatility and overvaluation may compromise Tesla while they move through the introduction and growth phases of their business. Opportunities for Tesla. A few opportunities are natural resource shortages and a shifting political landscape should benefit Tesla. And emerging markets in BRIC countries should provide Tesla some growth opportunities. And finally, Tesla's competitors are seemingly uninterested in taking an aggressive position to compete in the electric car market, which should provide Tesla a competitive advantage. As far as threats, $80,000 for a Model S prices Tesla out of the market for the majority of car owners. So I look at that as a major threat for Tesla. They do have plans to go with the $30,000 to $35,000 offering, but that won't be ready for some time. Additionally, I think other large auto companies can leverage their financial resources to put pressure on Tesla as they become more interested in competing in the electric car market. One final threat would be hydrogen fuel cell technology, which could challenge the electric car market. I mean, these vehicles are projected to be mass-produced by 2020, and I think that would cut into Tesla's market share at that point. All right, Porter's 5 forces. These 5 forces are bargaining power of suppliers, of customers, threat of new entrants, threat of substitute products, and industry rivalry. Starting with bargaining power of suppliers, Tesla is in a strong position with its suppliers. Tesla is able to create value from suppliers competing for their business. Tesla's battery pack, electric motor, onboard charger, and universal connector are produced by Tesla, but almost everything else is sourced. So Tesla's reputation and potential for growth creates value for investors in terms of reducing bargaining power of suppliers. On to bargaining power of customers. The bargaining power of customers is high due to a wide variety of cars consumers can choose from. Buyer power for consumers with sights set on an electric vehicle, however, is extremely low because Tesla has proven to be the overwhelming choice in the electric car market. As far as threat of new entrants, virtually all major car competitors have an electric vehicle program and have the financial resources to pose a risk to Tesla. Further, competitors like Ford, GM, and Toyota all have well-developed distribution networks and strong brand names. It's unlikely that another startup company will pose a direct risk to Tesla in the electric car market because of the technology, financing, and infrastructure that's required to compete in the electric car market. Other major autos simply aren't engaging yet in the electric car market until it's further developed. The threat of substitute products, it's currently low for Tesla. Tesla buyers not only want the electric car, but also want the prestige, gadgetry, operating efficiency, advanced technology, and luxury that will come with a Tesla. Substitute products at present are vastly inferior to the Tesla models available. As far as industry rivalry, The electric car market is rapidly growing in China, US, and Germany, and projected to continue to grow moving forward. A larger and fast-growing industry will be a positive for Tesla because they will sell more electric vehicles and generate more revenues. Okay, on to liquidity ratios and financial ratios in general. Tesla's liquidity ratio trending, looking at this chart, shows 2011, 12, and 13 liquidity ratios for Tesla. This chart highlights Tesla's overall improvement in short-term solvency and liquidity ratios in 2013. Tesla has $1.88 in current assets for every dollar in current liabilities. A current ratio above 1.5 and below 3.5 is generally considered to be acceptable. Moving on to financial leverage ratios. This shows total debt, debt equity, equity multiplier, times interest earned, and cash coverage. As of December 31st, 2013, Tesla had 28 cents in equity and 72 cents in debt for every dollar in assets. Tesla reduced their overall debt ratio from 81% in 2012 to 72% in 2013. Although this is trending in the right direction, Tesla needs to continue to reduce their debt leverage so they can increase borrowing power and reduce the risk of the stock for potential investors. The debt equity ratio and equity multiplier are consistent with Tesla's debt ratio. Moving on to asset utilization ratios, Tesla has made a strong improvement in inventory turnover in 2013 compared to 2012, especially considering that revenues increased drastically in 2013, which is another variable that put additional pressure on management. Tesla averages 80 days sales in inventory. Tesla's competitors, GM and Toyota, average 34 and 30 days, respectively. Tesla has strong receivable ratios with a day-in sales ratio of 8.97. This means that the average customer pays Tesla in just less than 9 days. For every dollar in assets, Tesla generated 83 cents in sales in 2013, which is an increase from only 37 cents in 2012. This was due to huge increases in revenues in 2013, but only a modest increase in total assets. In summary here of the asset utilization ratios, capital intensity for Tesla in 2013 is $1.21, which means it takes $1.21 in assets for Tesla to generate $1 in sales. Okay, moving on to profitability ratios. Although Tesla showed a loss in 2013, they greatly improved their profit margin. The stock price in 2013 soared as well. ROE for Tesla fell significantly in 2012 due to the company taking on higher debt levels, but it significantly improved in 2013 as revenues increased and the rate of new short-term and long-term debt leveled off. In terms of market value ratios, the PE ratio doesn't tell us much since Tesla operated at a loss in 2013. The market-to-book value ratio illuminates the outstanding returns the stock has given to its shareholders. The price to sales is 9.15. Exercise caution when using the price-to-sales ratio because it doesn't take into account Tesla's capital structure. The key takeaway from these market value ratios is that Tesla has shown shareholders a staggering 230% ROI in 2013. Now I'd like to take a minute to look at the ROE using the extended DuPont analysis and comparing Tesla to two competitors in the same space, General Motors and Toyota. The earnings before interest and taxes do not put Tesla in the black in 2011 to 2013. The EBIT margin is a profitability margin that's used to gauge growth. So Tesla made improvements in 2013 and has shown the most positive trend amongst competitors in this area. Toyota is also showing a steady improvement in EBIT. As far as interest burden, Tesla's interest burden increased to 1.86 in 2013 due to a large increase in interest charges. Toyota and General Motors had similar interest burden ratios. Now, as far as the tax burden, Tesla's tax burden has been consistent but needs improvement. General Motors, for example, incurred a large tax expense in 2012 from remaining government bailouts. Asset turnover, Tesla generated 83 cents on the dollar. which was higher than Toyota at 62 and lower than GM at 93. So this means GM has made the most efficient use of their assets over the past 3 years. Tesla has shown significantly more improvement in asset turnover versus competitors over the same time period. So as far as leverage, Tesla's equity decreased and total assets increased in 2012, greatly affecting the leverage ratio. With historically low interest rates, GM, Tesla, and Toyota have financed more assets through debt over the past 3 years. So in summary of ROE using the extended DuPont analysis, Tesla made gains in return on equity in 2013 due to increased sales and better inventory management. Now GM is trending in the wrong direction over the past 3 years, with ROE decreasing to just under 13% in 2013 from 17% in 2012. Toyota is showing consistent improvement in ROE the past 3 years, with increases of over 5% in 2012 and 2013. Okay, on to the earnings per share forecast. So since Tesla has no positive earnings thus far, I use the price-sales ratio to value this stock. So looking at revenues, expenses, net income, earnings per share on the left-hand column, onto historic data, 2013 and 2012, moving into common size, average and adjust, and the forecasts. 2014 forecasted revenue was adjusted down to a 38% increase over 2013 revenue based on Q1 and Q2 revenues. 2014 expenses were adjusted downward based on reduced expense ratios for Tesla in Q1 and Q2. Further, I adjusted revenues downward to account for U.S. GDP declines. U.S. GDP is projected to fall by 2.56 by the end of 2014 and rise to 2.85 by the end of 2015. So the earnings per share is estimated at a negative $1.81 based on these revenue and expense forecasts. Moving into the capital asset pricing model. This calculation here, I came up with 17.43%. which means that Tesla will need to return more than 17.43% for this to be a sound investment from a risk standpoint. The beta of the Tesla stock is fairly significant, along with all the other financial outlook of the stock. This is a pretty high number for the CAPM. Okay, finally the valuation. I forecasted sales revenue to grow 38% in 2014. So sales and stock prices have grown at a close rate historically at Tesla. For example, sales from 12 to 13 grew 387%, and the stock price grew 335% in the same period. So price to sales ratios are staying consistent. Therefore, I forecast the stock price to grow at the same rate as revenue in 2014. If this holds true, Tesla stock will fall from current levels of 235 to 206 by the end of the year. So in conclusion, Tesla, while it's a great company with great vision and well run with a strong leader, is not in a financial position, I believe, to continue to hold the stock. Again, my recommendation is to sell this stock. Thank you for your time. I hope my information has been worthwhile.